Stop scrolling because what just happened in silver is the kind of move that rewires markets, ruins careless traders, and quietly makes patient people very rich. And if you blinked, you missed the first punch, but the second punch is still loading. If you want to stay updated like them, consider joining. Just click the link in the description or tap the join button below. It won't take more than 30 seconds. Now, let's get straight to it. Silver and gold aren't moving, they're detonating. And the craziest part is not the price you saw on your screen. It's what that price is telling you about stress inside the system. Right now, silver is trading around $115 an ounce after tagging roughly 117 during the spike. Gold is sitting above 5,200 an ounce. Platinum and palladium are catching bids too. The entire complex is acting like a siren is going off in the background. And here's the number that quietly confirms it. The dollar index is hovering around the mid-96 and flirting with fresh lows for this cycle. That matters because metals don't live in a vacuum. They're priced in currency. When confidence in currency wobbles, metals don't whisper, they roar. But none of that is the main signal. The main signal is the shape of the market, because today's silver is trading stronger than tomorrow's silver. That's backwardation, and it's weird. Let me simplify it without the textbook noise. In a normal market, if you want something delivered later, you usually pay a little more because time has a cost. Storage, insurance, financing. Future delivery is supposed to be more expensive than give it to me right now. So, when you see the spot price above the futures price, it's like the market is saying, I'll pay extra to get it immediately. Why would anyone do that? There are a few reasons, and this is where you need to keep your head. 1, it can be a temporary distortion caused by funding rates, positioning, or a scramble around contract mechanics. 2, it can be a signal that there's a premium for immediacy, meaning real buyers want metal now, not a promise later. 3, it can reflect anxiety about delivery. Not guaranteed failure, not a movie-style collapse, but a rise in perceived risk. And in silver, perceived risk is powerful because silver is smaller than people think. It doesn't take a giant wave of new demand to stress the pipeline. It just takes demand arriving faster than supply can move. So when backwardation pops up at the same time volatility explodes, the right mindset is not panic. The right mindset is pay attention. Because backwardation is not a headline, it's a symptom. And symptoms show up before diagnosis. Now let's talk about the volatility, because this is where most people get psychologically wrecked. You saw silver rocket up, then slam down, then bounce hard. That's not a normal day in a normal market. That's the kind of range traders remember for years. But here's the trap. People see a brutal red candle and assume the top is in. In real bull markets, that assumption gets people eaten alive. Bull markets don't glide. They whip, they move up, they punish late buyers, they scare early holders, they lure in leverage, then they crush leverage, and only after they've cleaned out weak hands do they continue. That's why old traders say the trend climbs a wall of worry. It's not poetic, it's practical. The market has one job: transfer assets from impatient hands to patient hands, and volatility is the tool it uses. So, if you felt your heart rate spike during that move, congratulations, you were experiencing the buck-off phase. Now, here's the part you really need to understand because it explains why the bucking happened exactly when it did. In the paper market, timing matters, options expiration, contract roll windows, dealer hedging, thin liquidity periods. If you've ever watched a big move happen right near a key deadline, it's not always because somebody is evil. It's because the market is mechanical. When liquidity drops, smaller orders move price more. When dealers are hedging large options books, they push and pull the underlying in ways that look like madness. When traders try to front or run that behavior, you get cascades. So yes, the move can look engineered. But the smarter way to view it is incentives plus mechanics equals predictable chaos. And here's my skeptical counterpoint to the loudest narrative online. Not every sharp down tick is a shadowy plot. Sometimes it's just a crowded trade meeting, a thin order book. Sometimes it's risk desks forcing people out. Sometimes it's a stop-loss waterfall. The end result feels the same, but the cause matters because it changes how you position. Now, here's the cliffhanger. The craziest part wasn't the price swing. It was the size of the swing in terms of value and volume. In one session, the paper market effectively traded an amount of silver that would take miners years to pull from the ground, years in a day. That tells you the battlefield isn't the coin aisle at your local shop, it's derivatives, leverage, and who can survive margin calls when the tape turns feral. And when a market can throw around that kind of notional value in hours, it does something scary. It turns the price into a weapon. It can shake you out even if you were right. It can trigger forced liquidations. It can make people swear off metals forever, right before the trend resumes. That's why I always tell you the question isn't, is the thesis right? The question is, can you stay in the game long enough for the thesis to pay you? Because the move isn't just big, it's fast. When silver adds hundreds of billions of dollars of perceived value and then gives a chunk of it back in the same day, that's not a sleepy commodity, that's a market undergoing a regime change. And it has a side effect. It pulls attention from everywhere else. People who only talk tech stocks start mentioning metals. People who live in crypto chats start asking how silver works. And when that happens, you get a feedback loop. New money arrives, price rises, attention rises, more money arrives. That loop can run far longer than skeptics think, especially in a market as small as silver. But there's another side to the loop. When the loop is running, the market becomes hypersensitive to micro events, deadlines, settlement days, big option strikes, positioning reports, and sudden liquidity gaps. That's why you can see a violent dip that seems to come from nowhere. So, if you want to keep your sanity, you don't stare at every tick. You zoom out and you watch the structure, and the structure is still screaming tight. Now, let's move to the signal that, in my opinion, matters even more than the paper fireworks, the physical premium overseas. Based on recently published numbers, physical silver in the Chinese spot market has been closing far above the US spot, quote, by roughly $20 an ounce at times. Same metal, same day, two very different prices. That kind of spread doesn't exist for fun. It exists because physical flows and regional demand are out of balance. And what makes this even more interesting is that the futures quote there can sometimes sit below the spot quote too, which is basically backwardation showing up on multiple stages of the same play. When you see spot stronger than futures in more than one major region, it's like hearing the same alarm from different rooms in the house. Does that mean the house is burning down? Not necessarily. It means heat is building. Does that mean you personally can buy here and instantly sell there? Probably not. Real-world frictions are brutal: shipping, taxes, timing, compliance, and plain old logistics. But the existence of a persistent premium is still a loud message. It's the market whispering. The physical story is not the same as the paper story. And if you want to know why that matters, consider this. Futures contracts can be rolled, positions can be netted. Many traders never intend to touch a bar. But physical buyers can't roll a factory line. They can't net out a manufacturing schedule. If they need silver, they need silver. So when physical prices separate from paper quotes, it's revealing something. Real-world demand is pushing harder than financial positioning can hide. Now, let's widen the lens because silver is not moving alone. Gold above 5N200 is a message, and silver moving faster than gold is a second message. It's saying the market isn't just buying safety, it's buying scarcity with torque. When silver outperforms, it's usually because the market is repricing it as more than a decorative asset. It's repricing it as a utility metal with monetary optionality. And that's why the narratives are getting louder. You're hearing 200 silver. You're hearing 500 silver. You're hearing gold to the moon. Here's my take. Big numbers are not impossible, but they're not guaranteed. The path matters. The timing matters. And psychology matters most of all. A move to 200 doesn't require magic. It requires persistent physical tightness, ongoing investment demand, and a macro backdrop where real yields don't keep up with inflation. And even after the surge, those ingredients are still on the table. Over the past month, silver is up roughly 60%. Over the past year, it's up several 100%. Gold is up strongly too. That's not a little retail fad. That's a repricing cycle, a move to 500. That typically requires one of three things: a severe supply shock, a policy shock that destroys confidence in currency, or a speculative stampede so aggressive it drags future demand into the present. Could it happen? Yes. Would it feel logical while it's happening? No. It would feel like a storm. and storms make people do dumb things. So, I want you to focus on indicators, not hype. Indicator 1, backwardation showing up more than once. Indicator 2, the gap between physical pricing in the East and quoted pricing in the West. Indicator 3, the scale of paper volume versus real-world supply. Indicator 4, the dollar's direction. Because if the dollar keeps weakening while metals keep pushing higher, the story shifts from speculative spike to structural repairic. From recent market updates, gold holding above 5,200 while the dollar softens is a textbook confidence leak. It suggests people aren't only chasing momentum, they're hedging uncertainty, purchasing power erosion, and the sense that policy is being pulled in conflicting directions. And speaking of policy, let's talk about what changed this week that most people aren't connecting to metals yet. U.S. consumer confidence just slid to levels not seen in a long time. That feeds into spending, hiring, and the central bank's ability to stay restrictive. At the same time, global currency markets are shifting. When other major currencies start strengthening and the dollar fades, it can create a tailwind for dollar-priced commodities. Not because the world suddenly loves commodities, but because the measuring stick is shrinking. Now, before we jump into the retail side of this, let me do one fast housekeeping thing. Check the description. There are bonus links there, including a premium WhatsApp channel link and a channel membership join link. And we offer members-only videos produced by a separate team. They go deeper, they use more research, and they're only for premium members. So if you want the extra layer, that's where it is. All right, back to the money. Let's talk retail demand because this is where people get trapped in a small window view. You'll hear, my local shop has more sellers than buyers, or my local shop isn't buying right now. That can be true in one town on 1 week and still be meaningless globally. Local stores depend on wholesalers, refiners, and shipping. In a high volatility environment, those pipes clog, spreads widen, buyback programs pause, inventory gets weird. It doesn't mean demand vanished. It often means the plumbing is struggling to, quote, risk without getting burned. Meanwhile, online inventory can look stressed, shipping estimates stretch, and premiums behave strangely. That's a better thermometer for broad retail behavior because it's where modern buying actually happens. And outside the US, retail behavior is often the opposite of what people expect. In parts of Asia, precious metals are not treated like a trade. They're treated like a savings discipline. So price rising doesn't always scare buyers away. Sometimes it validates the asset and pulls more buyers in. But here's the cliffhanger. Retail is not the main event. The main event is industrial pull and institutional repositioning. And that takes us to supply. I keep hearing the comforting story, if prices rise, miners will flood the market with supply. That's not how this works. Silver supply is sticky. Most silver is produced as a byproduct of other mining. Copper, lead, zinc. That means you can't just snap your fingers and double output because silver went up. You'd need new projects, new permits, new processing capacity, new capital, and time. And time is the one thing the market refuses to wait for when a narrative catches fire. Here's another piece people ignore. Even if mining companies want to ramp up, they often face energy costs, labor constraints, and permitting timelines that don't care about your chart. Higher price is an incentive. But it isn't a switch. That's why scrap matters too. When prices rise, more scrap comes out. Old electronics, old jewelry, industrial recycling. Scrap can cushion a shortage for a while, but it's not unlimited. Scrap is a response, not a permanent solution. It helps, and then it runs into its own ceiling. And when you combine slow mine response with limited scrap response, the only lever left is price. According to the latest publicly available filings and project pipelines, meaningful supply expansion isn't next month. It's measured in years. That's why price has to do the balancing work right now. Higher prices ration demand. Higher prices force substitution where possible. Higher prices pull scrap supply out of hiding. Higher prices eventually fund new mines. But until higher prices do their job, the market stays tense. That tension is what you're feeling. Now zoom out with me because this is where the story gets even more interesting. Silver doesn't just have a supply problem, it has a quality of demand problem. Industrial demand doesn't sell when the price goes up. It complains, it hedges, it tries to optimize usage, but it still needs metal. Investment demand can be more emotional, but it can also be sticky once people adopt a thesis about currency risk. So you have two demand sources with different behavior patterns that creates unpredictable price reactions, especially during shocks. Now, layer in the possibility of official stockpiling. There's growing discussion about governments treating critical inputs as strategic assets. Silver shows up in that conversation because modern infrastructure and defense systems consume it. If even a modest policy shift increases strategic inventory, that adds a buyer who doesn't care about daily candles. But let me stay disciplined. Policy chatter is cheap. Budgets get delayed. Politics shifts. So I don't build my whole thesis on one rumor. I build it on the direction of pressure. And the direction of pressure is clear. Demand is rising in more places than it's falling, and supply cannot sprint. So if you want to be smart here, stop obsessing over one day and start watching the month, because the month chart tells you whether this is a blow-off or the beginning of a new regime. Now, there's a question I keep getting. Is this about paper silver or physical silver? And that's a fair question because the experience feels different depending on what you own. Paper exposure is fast. You can click in, click out, but it's also where the leverage lives, and leverage is exactly what turns a normal pullback into a wipeout. Physical is slower, it's heavier, it's not designed for flipping in and out every Tuesday, but physical is also the form that can't be created with a keystroke. That's the whole point. So when you see backwardation and you see overseas premiums and you see volatility, you should immediately ask which market is leading, paper or physical. Because if physical is leading, paper eventually has to follow. And if paper is leading, physical can lag for a while until it doesn't. Here's how I think about that without pretending I can see the future. When the move starts, paper usually moves first because it's liquid and it's leveraged. Then physical starts getting stressed because higher prices pull in real buyers and spark inventory hoarding. Then premiums widen because the pipeline can't refill instantly. Then finally paper starts reacting to the physical stress, and that's when you get the truly scary days because the paper market has to reprick its own promises. That last phase is the one people remember. It's also the one that creates the this can't be real price targets. So what phase are we in right now? I'd argue we're in the transition. The paper market is doing what paper always does, violent repricing, but the physical market is confirming it with premium behavior. That's why this isn't just a speculative chart story. It's a logistics story, and logistics stories don't end politely. Now, if you're thinking, okay, John, but what's the actual trigger that causes a blow-off? It's usually not one big announcement. It's a chain reaction. It starts with a few big buyers refusing to sell. Then it moves to wholesalers raising premiums because they can't restock safely. Then it moves to manufacturers paying up because they can't afford to stop production. Then it moves to traders realizing the paper price is being underwritten by physical demand they can't ignore. Then it moves to shorts scrambling not because they changed their opinion, but because their margin math changed. And that's when the market stops caring about your logic. That's when it becomes a pure auction. Now let's talk about something that sounds boring but actually matters a lot. Delivery months. Futures contracts have calendar pressure. As the delivery window approaches, the market has to decide who is rolling, who is closing, and who actually wants delivery. Most people roll. But a small percentage taking delivery can still matter because silver is tight. So when you hear people mention a specific month, it's not superstition. It's because that's when paper promises are closest to the physical world. And if there's even a tiny rise in the number of participants who want the metal instead of the paper, it changes the math. That's why you can see backwardation flare and then fade. Flare and then fade like a warning light that comes on under stress. Now, I also want to point out something that gets ignored. These levels are not just higher, they're psychologically disruptive. 100 silver is a billboard. It forces every institutional model to update. Risk managers see it and ask, do we have exposure to this? Producers see it and ask, do we hedge more? Manufacturers see it and ask, do we lock in supply? Investors see it and ask, what else is being repriced? And the moment those questions start getting asked in boardrooms, it's not a retail story anymore. It's policy adjacent. It's macro. It's big. Now, because I want this channel to be useful, I'm going to share how I personally think about staying sane in this environment. First, I separate conviction from timing. I can believe a long-term thesis and still admit I don't know what tomorrow's candle looks like. Second, I respect volatility. I don't treat it like a glitch. I treat it like a feature of the phase. Third, I don't let a good idea become a bad decision by oversizing, because the fastest way to lose is to be right with the wrong position size. And fourth, I keep a watch list of stress signals, not to obsess, just to stay aware. Things like, are premiums expanding or shrinking? Are spot future dislocations showing up? Are daily ranges growing? Is the dollar sliding? And is the central bank being forced to react? When those stress signals stack up, that's when you see moves that don't give you time. And right now, those signals are stacking. So if you're new, don't fall into the trap of thinking you must act today or you'll miss everything. Markets always give more than one opportunity. The real skill is being ready when opportunity arrives, not being frantic when a candle is green. Because the people who get destroyed in bull markets are usually the people who join late with leverage because they felt emotional pressure. Don't be that person. Be the person who's calm enough to think. And if you're already involved, don't let today's excitement make you forget why you cared in the first place. Scarcity plus currency weakness plus industrial demand is not a one-week story. It's a multi-year theme, but the ride will try to convince you it's over at least 10 times before it's actually over. Now let's address the elephant in the room. Is silver past fundamentals and purely speculative? Parts of the move, yes, are speculative. Anytime something goes vertical, momentum traders pile in. That's normal. But calling it only speculation ignores the physical premium, ignores supply constraints, ignores industrial demand, ignores currency weakness, and ignores the reality that gold and silver have been money longer than any central bank has existed. What I think is happening is simpler. Silver is catching up to a world that changed faster than the pricing models did. The market spent years pricing silver like a sleepy relic. Then the world demanded electrification, grid upgrades, AI infrastructure, defense spending, and supply chain redundancy. All while monetary policy trained people to distrust purchasing power. So now silver is repricing. And repricing looks violent because it breaks old anchors. Here's the twist. The same violent repricing that scares newcomers is exactly what attracts bigger money, because big money doesn't chase comfort. Big money chases trend and scarcity. So if you're wondering whether sophisticated money is watching this, the answer is yes. And the proof isn't a social post. The proof is the tape, the magnitude of the moves, the speed of the rebounds, and how quickly dips get bought. Now, I'm not here to tell you to mortgage your house for silver. Don't do that. I'm here to help you think clearly. So here's the clearest thought I can give you. The only thing that truly fixes a supply-demand imbalance is price. Not promises, not narratives, not paper claims, price. And until price rises enough to do that job, the market stays jumpy. That's why I want you to watch levels, not headlines. Watch whether silver holds above the big psychological zone around 100. If it consolidates, that's not weakness. That's the market building a new floor. Watch whether the physical premium overseas stays wide. If it does, it means the physical bid is still intense. Watch whether daily ranges start compressing after spikes. That can mean absorption. And watch the dollar. If it keeps drifting lower while metals stay bid, that's a strong confirmation. Now let's bring in the macro catalyst. Everyone is staring at the central bank decision later today. The target range for short-term rates is currently around 3.12 to 3.34, and the market is leaning heavily toward no change in the immediate decision. That matters because it frames what counts as surprise. If there's no change and the tone is neutral, the market goes right back to watching growth and inflation. If the tone turns even slightly more dovish, if future cuts are hinted, if economic weakness is acknowledged, metals get a fresh tailwind. If the tone turns hawkish, that's the stress test. Because in a genuine repricing, metals can rise even when policymakers try to sound tough, because the market senses the limits of toughness. So here's the real question. Are we in a world where the central bank controls metals, or a world where metals are exposing the limits of the central bank? That's not rhetoric. That's the game. Now let's talk about the dollar index because people treat it like a scoreboard when it's really a comparison chart. It measures the dollar against other major currencies, and those currencies have their own problems. So when the dollar looks strong on that index, it doesn't automatically mean the dollar is strong in your grocery cart. What's fascinating right now is this. Even with the dollar index not at historic lows, gold and silver are at levels that in past cycles would have required a dramatically weaker dollar. That divergence is a clue. It suggests additional drivers, reserve diversification, global demand for hard assets, and a broader loss of faith in paper promises. And there's historical rhyme here. When the dollar drifted lower over multi-year stretches in past cycles, metals didn't just rise, they ran. Not every year was up, not every month was easy, but the direction was clear when the measuring stick kept shrinking.